Welcome to The Explainer. Today, we're going to peel back the layers, look past the big headlines, and really get into what makes a company truly great.
Okay, so how do you really know if a company is great? Is it all about those flashy revenue numbers going up and up? I mean, it's easy to get caught up in that, right? But the real story, the one that tells you about long-term success, well, that's usually buried a little deeper. So let's start digging. Just take a look at this chart. It's Costco versus its main competitors. See that line way up top? That's Costco. That line represents something called Return on Invested Capital, or ROIC for short. And you can see it's not just a little higher, it's consistently pulling away from the pack. That one metric, it tells us so much. So what is it exactly? All right, so if we're going to get this right, if we're really going to understand what's going on inside a business, we have to look past the obvious stuff. We need a better toolkit. And today, that toolkit is built on two incredibly powerful pillars: Return on Invested Capital, or ROIC, and what we'll call true revenue growth. So let's start with that first pillar, Return on Invested Capital, ROIC. What in the world is it, and why does it matter so much? You know, at its core, ROIC answers a really simple but super important question. For every single dollar a company puts into its business, we're talking everything from factories and stores to all the stuff on the shelves, how much profit does it actually make after it pays its taxes? It's that simple. The higher the number, the better the company's at turning money into more money. It's a measure of pure efficiency.
Okay, but here's a little twist. ROIC, as great as it is, can sometimes be a bit misleading, and this usually happens when a company makes a huge acquisition. There's this little thing in accounting called goodwill, which is basically the extra money a company pays for another business above and beyond what its assets are actually worth. And that goodwill can really mess with the numbers. Let's see what that looks like.
This is a perfect example. We're looking at the luxury brand Tapestry here. Now that dotted line, that's their ROIC, including all that goodwill from their big acquisition in 2017. See that massive drop? Yikes. But look at the solid line. That's the ROIC of their original business, without the goodwill. It tells a totally different story, right? Their core operations were actually still pretty healthy, and that's exactly why you've got to look at both versions.
So knowing a company has a high ROIC is a great start. But honestly, that's just the what. The real magic, the insight that lets you understand their secret sauce, their strategy, their edge over the competition, well, that comes from digging into the why. Why is their ROIC so good? Or so bad?
And this is how we find the why. This is called an ROIC tree. It basically breaks the number down into its different parts. And when you do this for Costco, you find something really surprising. You'd think their secret is making a ton of profit on everything they sell, right? Nope. Look at this. Their operating margin is actually lower than their competitors, just 3.2% compared to 5.1%. So, wait a minute. If they're making less profit on each individual sale, how are they so successful? Well, it all comes down to one word: speed. Or, to be a bit more technical, capital productivity. They are masters of efficiency. They don't sell a million different things, they sell a curated selection of stuff that just flies off the shelves, incredibly fast.
And just how fast are we talking? Well, back in 2018, an item would sit on a Costco shelf for just under 31 days. For their competitors, almost 53 days. Think about that. They turn their products into cash almost twice as fast. That means the money they've invested in inventory isn't just sitting there, it's working for them, generating returns way faster.
Okay, that's pillar one. Now let's move on to our second pillar, revenue growth. And just like with ROIC, the big flashy headline number can totally fool you. We need to hunt for what's called true, or organic, growth.
And to find that true growth, we basically have to play detective and strip away three things that can distort the picture: wacky currency fluctuations, big mergers and acquisitions, and any one-off accounting changes.
M&A is a huge one. Just look at this table. In this example, the company's real organic growth is chugging along at a nice, steady 10%. But then, boom, in year 3, they buy another company. Suddenly, their reported growth skyrockets to almost 23%. It looks fantastic on paper, but the actual core business, it hasn't gotten any better.
Then you've got currency effects. If a company sells stuff all over the world, changes in exchange rates can make their revenue look bigger or smaller, even if they're selling the exact same amount of product. And finally, you gotta watch for weird accounting changes. A company can change a rule one time, and it creates this phantom spike or dip in growth that isn't real.
So, why are we going through all this trouble? Why does all this detailed analysis matter? Well, it's simple. Because over the long haul, the stock market figures it out. It rewards companies that are truly performing well, not just the ones that look good on the surface. And that's where you see the ultimate payoff.
And here is the proof in the pudding. For years, the market valued Costco pretty much the same as its competitors. They were all lumped together. But then, as the story of its superior, sustainable performance became undeniable, look what happened. Its valuation multiple, basically how much investors are willing to pay for its earnings, just completely detached and took off, leaving everyone else in the dust.
So it all comes back to this, really. Strong ROIC and true organic growth. These aren't just fancy metrics. They are the fundamental building blocks of creating real, long-term value. If you can analyze these, you can get past the noise and understand the real story of a company.
So the next time you're looking at a company, ask yourself, what story are the numbers really telling me? This framework gives you the tools to find out. Thanks for watching The Explainer.